All right, folks, welcome back to the channel. Tuesday, March 21st, we got us a nice green day on the market. Absolutely crazy short squeeze we are in the middle of right now that just keeps squeezing up. Absolutely nuts. We have our Fed meeting tomorrow, so we have a lot to jump into. The market has been doing some wild things. If you look at the Nasdaq today, we're up 1.5%. Look at the price we're at. We're at 310.5 on the Nasdaq. We haven't been at that price since way over here at the start of February. Remember the start of February? Everyone's like, see, inflation's done. Everything's good. This was pre-banking crisis. This was pre-Credit Suisse collapse. I mean, or not collapse, but they basically got bought for pennies on the dollar. So market is saying right now things look better in the future than they did before this banking crisis has started. So explain that to me. If anyone can, please do. This is the stock market. It is not rational. It is not emotional. It is just mechanical. So this is obviously everyone expected it to go down. It goes straight up. It squeezes shorts, and that just compiles more momentum, more momentum. When does your short squeeze end? Well, we'll talk about that. Today, it might be the last green day we see for a while. Who knows? But we got a lot to talk about. FOMC can completely shatter all expectations. So keep in mind, this FOMC is different than prior FOMCs. Prior FOMCs have mostly been compiled of us wondering, hey, is the Fed going to give us a hint on when they will pause? Are they going to give us a hint on if they're going to cut sometime this year? Are they going to do 0.25? Are they going to do 0.5, 0.75? What's going to happen? That's been the past FOMC meetings. This FOMC meeting is completely different because there has been a lot that has gone on. The Fed has been taking extreme measures to stabilize the banking sector. There has been this crisis that has come up that no one knew about last FOMC meeting. I mean, they weren't talking about, yeah, the banks might collapse soon. So this is all new. So we have completely changed. Everything has changed. This FOMC meeting is going to be huge. On top of that, they are giving us, it's so crazy that these things always happen at the same time. They're giving us their update on the economic projections. They do that, I think, twice a year, maybe once a year. No, I'm pretty sure it's twice a year, where they give us their projections on where they expect interest rates to be years from now, where they expect inflation to be years from now, where they expect all these things, GDP, unemployment. It's huge. So that is almost as huge as the rate hike itself. Right now, I'm pretty sure everyone's basically agreed upon the fact that it's going to be a 25 basis point hike. It could be a flip if they pivot. Say no hike, I expect that will send stocks to the stratosphere, because the only thing that is clear right now is that we have gotten some pain. Inflation doesn't matter. We have seen pain, so they're going to cut rates. Cut rates means stocks go up. That's why that's been this entire rally, is that the market is continuing to price in that the Fed will pivot sometime this year, even though Powell has said meeting after meeting, no cuts in 23, no cuts in 23. We're not cutting in 23. Instead, he's come out and said, oh, looks like we're going to go from 5% to maybe 5.5%. I would say a pause is alarming to the normal person, because they know a lot more than we do. If they are looking under the hood of the truck that is the banking industry, and they are seeing a lot of chaos and potential contagion effect, things getting out of hand, banks just collapsing, and they pause, then that to me is like, whoa, what are they seeing that we're not seeing? I don't think a pause would just save everything. It's more so if they continue to quantitatively ease things, where they print money, basically. Which, by the way, they did that, $300 billion last week. Anyways, so we're expecting that 25. Lots of banks have been coming out and they've been saying pause, just pause. Banks have kept coming out and they're advocating for a pause. Goldman Sachs did it today. Wells Fargo did it last week. A bunch of the big four people at these big four banks are coming out and they're saying, hey, you guys should be pausing right now. And then they say, pause for now and see what happens in the banking sector, and then resume. Why is that crazy? Well, we're going to talk about that. This whole thing is precedented. We have had inflation like this before. Back in the 70s, baby. It all started back here. Back in the early 70s. We got inflation coming up in the 70s. And what happened? Well, we had Arthur Smith. He was the Jay Powell of the day back then. And he did some crazy shit because they didn't know how bad inflation could get back then. They really had no idea how terrible it could get, because they really didn't have a situation to look back on. That's why we're lucky. We can look back at the 70s and be like, hey, we won't repeat their mistakes, which, by the way, Powell has said over and over and over again. So what do they do back in the 70s? Well, inflation starts to rise in the 70s. They jack up interest rates. They go from over here at 6%, they jack them up to 10% basically in a year. Then inflation cools. So what do? Well, they go, gee whiz, inflation's coming down. Let's drop our rates a little bit, huh? How about that? Everyone likes low interest rates. Let's drop them down to 3.7. Ah, shoot, inflation's back up. Let's shoot it back up to 5.7. Oh no, too much pain. Let's shoot it back down to 3.5. Oh shoot, now inflation's really bad. Now we got to go from 3.25 all the way up here, all the way up there to 12.5%. And that was just in 74. So they jack it up to 12.5%. Huge, crazy interest rate hike. And then inflation finally cools. So what do? They drop it back down. All right, let's ease things up. Go down to 6%. Oh, hey, inflation. Oh, God, inflation's back up. Let's jack it back up to 6.25 from basically 5.25. Let's jack it up 1%. All right, inflation's down. Let's drop it back down. All right, it's coming back up. Raise it back up. Drop it back down. And then inflation gets really bad, early 80s. Then that's where we get Paul Volcker. And Paul Volcker comes out and he says, this is the 70s. This here was a nightmare. Let's not do that anymore. So he's like, I'm going to kill this thing for good. We're going to shoot this thing up to 20%. And that was extremely painful for everyone. That was, unemployment got to like 10% back then. Inflation was sky high. Recession, it was a nightmare. No one wants to do that. The Fed has been saying over and over and over and over, they're not going to do that. Yet the banks are coming out and being like, hey, they should pause and then continue to rate hike for the coming months after that. It's just, it's mind-boggling. It's really like hard to grasp, like wrap your head around that the banks think that the Fed should do something so dumb. And for something that you can literally whip up a chart and look back and be like, wow, the 70s, that was a rough time, because they just kept flip-flopping. And then that's inflation. It's very psychological. It gets entrenched. When it stays this high for this long, for a decade, it becomes entrenched and it gets out of hand. It just goes crazy. And that's what happened back here in 1980. It just went crazy. It was entrenched. Everyone was expecting it. Everyone was asking for big raises because they're like, well, I'm inflation, so I need a bigger raise. That's the definition of it becoming entrenched. So that's the risk. If they were to pause, if they were to cut anytime soon, we know inflation is still at 6%. We know the drop in inflation has mainly just been because of the drop in oil prices. It hasn't been any drop anywhere in the core. The core CPI is still 0.6 month over month. So you annualize that, that's still well higher than what they are going for. That's still very high. So that is one thing. The stock market doesn't care about the inflation. They just care about the rate cuts. That is why the stocks are going straight up right now. Like, obviously, things are still bad. Inflation's still at 6%. So it is becoming more and more likely that we are going to be entering that period of stagflation, where everyone last year was talking about, oh, God, stagflation. We can't do that. That is looking like where we're going to be heading if the Fed does pause, because they have been saying inflation is their number one goal. Inflation. But now we got the bank problem, and now they're like, oh, shoot. Well, maybe that shouldn't be our number one goal. Maybe the bank's collapsing is worse than inflation getting out of hand. So maybe they cut for like a year to save the banks. But then, oh, inflation's at 10% and it's entrenched. And now we have 5 years of pain because we have stagflation. So stagflation, that is, imagine you, or I won't say you, I don't want to like scare people. Say your friend from college loses their job in a period of stagflation. Well, their prices on everything continues to go up. Their rent continues to go up. Their electricity, their utilities, their food, everything continues to go up, and they just lost their job. Imagine how painful that is for us common folk. So it would just be a complete travesty to me if the Fed were to come out and cut rates. That would be them abandoning the fight against inflation to save these shitty, stupid fucking banks that have made terrible trades. It would just be a complete travesty to me. And I know the stock market will go up, but it is mechanical. It's not emotional. It doesn't care about the normal people. I mean, it only cares about normal people if they start to run out of money and if they start to lose their jobs, which they haven't. And then that's when they get worried. So people are still spending money. That's why this inflation thing is just still so bad, because unemployment is still so low and everyone's still spending crazy amounts of money. So anyways, let's look at what the market is pricing in. So we look at our FedWatch tool here, and we're basically almost 90% that we're going to get that 25 basis point. So tomorrow, that will not be news. Everyone expects it. Tomorrow, it's news if they cut or if they pause, if they go no rate hike, which 13% chance of that. There's 0% chance that they cut. They're not going to cut. Don't even think about that. If they do cut, then stock market's going to go up 10% one day, basically. I mean, take my word for it. I don't know. I know I've sounded bearish mostly on this, but it's become extremely evident that at this point, rate hikes is all that the market cares about. Rate hikes and rate cuts, not about inflation, not about the banking crisis, because that only gets worse and worse by the day. That's all the market cares about is these rate hikes and cuts. So here in May, so it looks like this has changed. Yesterday when I looked at this, we had a higher chance that we would get a pause in May. So yesterday, if you look down here on this here, zoom in, this is the 1 day change. So yesterday, it looked like the market had almost 50% chance that they were going to pause in May. But now that has gone from no pause to they're going to do another 25 basis point hike in May. So market pricing in at 25 in June, pricing in 25 in May. Let's look at June, or 25 in March, 25 in May. Let's look at June. June. All right, so this is where things get very interesting. It is looking like here, the market is putting a 50% chance that we see a pause in June, and then a 41% chance that we see a cut in June. So that is why the market is just going so crazy right now, because we are looking at these rate hikes and just saying, wow, they're going to start cutting in June. That's great. Rate hikes are they're going to cease to exist, and we're going to go back to that nice like 2.5%, 3% interest rate, maybe go back to zero. Who the hell knows these days? But that is what the market's looking at in June. So we have the market telling us that they're going to pause and maybe even cut in June. And then all that we've had the Fed telling us is that they are not going to cut at all in the entire year of 2023, nonetheless in June. So the market is 6 months early from what the Fed is saying. It's crazy. And this is all, we haven't heard anything from the Fed. They haven't talked recently. They have had no speeches, no conferences, no anything. This will be the first time we hear. So that's why this uncertainty is just at all-time highs right now. Because the Fed can come out and just say, no, this is all bullshit. We're not cutting in June. We're not cutting in July. We're not pausing in June. We are going to go up to maybe 5.5%, which is kind of what they've been hinting at. So right now, after tomorrow's rate hike, we are going to be sitting at 4.75%. They started their initial estimate for rate hikes was like 4.5, then it went to 5, and now it's leaning at 5.25 to 5.5. Well, right now the market is saying, nah, there's zero chance that we get to 5.5. There's 0% chance of that. That is exactly what the market is saying. 0% chance of that. I mean, it's just crazy. So unless everything has changed, and that's the thing, is that the Fed has just been saying, no, inflation is number one, and that has just not gotten better. It just isn't getting better. It just is not. So we're on this cliff, and it's either Jerome Powell comes and he talks us off the cliff, or he comes and says, hey, you should jump off that cliff. That is exactly where the market is right now. And if we go back to the Nasdaq on close, let's see where we're closing at. Oh, looks like we've had a little bit of selling going into the close. No big deal. Very high volume selling. Daily volume looks weak as hell on the Nasdaq, and this is kind of expected. This is just a no news day going into the FOMC meeting, which always gets me a little worried when the market makes a big move like this on a day where nothing is happening, going into a day where the most important thing that happened to the stock market in like 2 years is happening. And tomorrow is the most important FOMC meeting we've had in years. Cannot stress that enough. So let's look at the VIX. VIX just falling off a cliff. This is weird. You see the VIX dumping into an FOMC day where there probably will be some volatility. That's a little sirens going off in my head, a little wee-woo, a little action, you know? So this is kind of where we're at. It's does Powell flinch? Does he say inflation is good enough, we're just going to start pausing? Or does he say, yeah, we see the pain in the bank sector, and we don't give a shit. That's your guys' problem. Unless things get cataclysmically bad, like 2008 bad, they're not going to pause, in my honest opinion, because that is just all they've been saying. I don't think enough has changed for them to completely ditch everything that they've been doing. That would, if they were to cut tomorrow or pause tomorrow or even pause in May, that undoes everything that they've been doing. They've been talking, wagging their finger down at inflation this entire time. If they come out and they just pause at the first sign of trouble, that undoes all of that. And they know that. These are smart people. They're not that stupid. I know they're stupid enough to keep pumping money into the market up until March of last year. I know it's only been a year. Keep that in mind. It's only been 1 year. This has been one single year of aggressive rate hiking, and the market is already cracking. The bank system, the whole financial system is already cracking. And mind you, it used to be standard that rates, if you look in the past, I mean, you look pre-2008, and it was pretty standard to have rates at about 5%, unless a recession happens. So 2000 happens, we're at 6.5%, and then we cut rates all the way down to 1%. And then, hey, all right, things are good. We're going to start raising rates again because that's good for everyone. It's good for inflation. We should not have just free, easy money for an extended amount of time if things are looking good. And then you look in the 90s, interest rates are kind of just sitting at 3% to about 6%. We're just in between there. That's that's where rates should be. So it tells you so much about the system that we all are stuck in, that going back to anything that closely resembles the original, like the average rates from back in the early days, back pre-2008, the fact that we are just barely knocking on the door of 5% and everything is just crumbling already tells you a lot about our system, and it tells me that things are probably a lot worse than we think. I don't want to just be panic, everyone panic, but it kind of tells you a lot. It tells you a lot about how the system has constructed itself in this entire period of 0% interest rates. I mean, this extended period of 0% interest rates, it's just crazy. And I have it on logarithmic. So that really looks even better on that chart. You can see that flat line. I mean, from 2009 till 2015, and then they took it up to 2%. And then, oh God, things got so bad then that we had to drop them back down. That was even pre-COVID that they started cutting rates. Keep that in mind. So that was Trump, though. Trump told Jerome Powell, hey, the stocks are going down. You got to drop interest rates, dude. I need to get reelected. But yeah, so, I mean, everyone knows the recession was basically done by 2012, 2013. Things were looking good, but they kept rates at zero. It's a travesty, and this is how we got here. So I don't know. It's sickening that we just stayed at this 0% for so long. So this is the first time. I mean, back at the financial crisis, we were gifted with not having inflation, so they could deal with that because they weren't worried about inflation. They were worried about deflation. That's how bad things are. That's how bad things were back in 2007, 2008, 2006, 2007, 2008, is that they weren't worried about inflation, and they had ammo. They could cut rates to help things. Now, the opposite. We're worried about inflation. We can't cut rates. We can't just print money. That's how we got this inflation. So it's a very, very interesting thing. I think the simple way to look at it is rate cuts equals stocks go up. And that has basically been why stocks are going up recently. And because it's so obvious that this was, I mean, now it's obvious. I didn't think it would happen, but it was like banking crisis. That's a red flag. Short, go short, go short. Market does the opposite. Most pain to the most people involved. That's what the stock market always does. So if we look at the S&P 500 here, all right, looks like we closed just below 399. So S&P 500 has been a little weak compared to the Nasdaq. Yesterday it was showing some strength, basically on the back of these bank stocks have started to rally a little bit. And now keep in mind the Nasdaq barely has any banks in the index. The S&P has a bunch of banks in the index. So when the banks collapsed, it was heavily affected by that. But banks are starting to go up, so S&P has been starting to go up. I think oil stocks are also, oil stocks, whoa-wee. If we look at XLE, damn, oil stocks making a big jump today. So S&P 500, what are my levels? Well, we have our clear supply up here at 401.25. Above that, next supply at basically 407. So if things are crazy bullish, we see a confluence right here. We have this really major key level at 403.50. I've talked about that so many times in my videos, that price level, and it has been money. You can see the price action there. When we tap it, we reject, break it, reject, break, reject, support, and then, we lose that, go short. we break it, go long, lose it, go short. So you can see the confluence. We have this trend line right there. We have 403.50 right there. I'm looking at that. To the downside, damn, this really kind of looks like a bear flag I'm seeing here. This is live charting. I'm seeing a bear flag-ish. So we have retaken the 200-day moving average on the S&P 500 on the back of zero volume. You can look at the volume down here. It's very weak volume. These first 2 days of the week before FOMC, everyone knew it was going to be low volume. So the fact that we're ripping up on this super low volume tells me bears are waiting for bad news. If the bad news doesn't come, they will not short. So that's where we're at. So to the downside, I could see if we get yanked back down below 393. I mean, we have a big gap now, 395. So FOMC day, you know how those days go. We get these candles that are just drop 1%, go back up 1%, drop 1%. So I wouldn't be surprised if we get one of those wacky-do fucking candles where we just plummet, fill gap, and then just go straight back up. Typically, I've noticed this. It's kind of like a gambling strategy because FOMC is literally gambling. If you're trying to trade on FOMC day, it's gambling 100%. Because it just computers, back and forth computers, just it's crazy. Algos just pumping, dumping left and right. You're too slow. You can't handle it as a human. They're way faster than you, and that's unfortunately the way it is. So I wouldn't be surprised if we saw one of those candles, fills gap, and then you just go straight back up. But what I've noticed on FOMC days is that often the initial candle, if you fade that candle, if the initial candle goes straight up, sometimes, typically, I've kind of noticed it's smart if we go straight up to buy puts and then we just go straight back down. Usually fading that initial move has kind of worked for me. I'm not a financial advisor. Do not do this at all. This is for education purposes, but that has kind of been what I've noticed. So obviously below 396 is bearish to me, but a bounce at 394, we can just go straight back up. It's really hard to chart pre-FOMC day because it's just such a crazy day, and it just throws technicals out the window. If things are overbought, it doesn't matter if we get good news because it's just going to go straight up anyways. Like some things are just, and this is just such an important, huge day. It's just crazy. So looking at the Nasdaq, it looks like Nasdaq on the daily has broken a bull flag, and it looks like technically it looks great. You cannot short this right now. You cannot short the Nasdaq. You can think about entering shorts, and then maybe if we continue to go up, grab some more. But right now, it just looks too bullish. That's just how it is. And we've just been shooting up on just crazy high volume, just insane volume. So Nasdaq still looks bullish. I really don't see a short opportunity on this yet unless we get news that kind of changes things. But this key pivot point I've had at 302.25 has been pretty money. So we pull back to that, bounce off of that. That seems bullish to me. But crack down below 298, 297. Nasdaq's looking rough to me. That's really all I got. I can't really zoom in on the chart and be like, all right, if we come down to 307, buy there, and then it'll go back up. Like FOMC day is just too crazy. So I'm not even going to bother with that. So that's where we're at. I'm not telling you to go long. I'm not bearish. I'm not bullish. Things sound bad. Things should come down. If this is a full-blown crisis and it's only just begun, then it could take months. It could take even a year until we see this fully capitulate. But in the meantime, if they come out dovish, if they talk about cutting rates in June, then the market will go up. Oh, it's going to go up, baby. We're going to see like a 7% day from the Nasdaq because think about the Nasdaq. The Nasdaq is already, it has already gone up almost 8.5%, basically 8.5% before we've even heard of it. It's gone up on that just on the assumption that we're going to see rate hikes in June. So if they confirm that, oh boy, you get ready, man. There's going to be some crazy movement. We're going to see the Nasdaq. I'm just calling it right now. We're going to push straight to 330 if they come out and say that. No joke. And that's not even me trying to be a crazy, so I can come on here and be like, see, I told y'all. I'm just saying that is going to happen. It's going to happen. So with that said, if you enjoyed the video, I'm sorry, this is a bit of a long one, but FOMC is just so crazy. It's so hard to talk about all this stuff in a short video. But if you enjoyed, I'd please ask you to consider hitting the subscribe button, hitting the like, dropping a comment if you disagree with everything I said, if you agree with anything I said. I appreciate all your comments, and I will most certainly be uploading tomorrow to talk about that FOMC day and the new developments we get. It is going to be thrilling, so stay tuned. We'll see you later.